Welcome to the Financial Confidence Podcast, where we help you build clarity, control, and confidence through every stage of your financial life. I'm your host, Mike Schuster, and in each episode, we'll explore real strategies, expert insights, and practical guidance to help you make informed decisions and move forward. Welcome back to the Financial Confidence Podcast. Today, my guest is John Schonberg from Stonebridge Capital Advisors. John is the Chief Investment Officer of Stonebridge, actually comes to Stonebridge via Columbia Management and Ameriprise. So lots of institutional background for John. John is a Husker, which he's coming home to Nebraska, and we're excited to have you here today in our podcast room as we're traveling the state to all of our branches. John, welcome to the podcast.
Thank you.
Yes.
Great to be here.
Well, thanks for coming. You know, one of the things that we like to talk about with our clientele or our customers is our investment philosophy at Schuster Anderson. We try to keep it simple, honestly. We collaborate with independent money managers just like you. And what's unique about that, and we've known each other now for I think almost 4 years, is that the client's success is then tied, you know, and your success too as the manager is tied to the client's success, which is a big deal. So that's really what I'll talk about first as you introduce yourself and talk a little bit to our viewers about what you do.
Yeah. So great to be back in Nebraska. Do come here regularly to visit family and friends, but and it's not that far from Minnesota. It's just a short 5.5 hour drive to Omaha, a little further to Grand Island though. But good to be here. Again, I work for Stonebridge Capital Advisors. I have over 40 years of experience managing portfolios. Risk-adjusted returns are important. I think the one thing that we like to focus on at Stonebridge, which I know you focus on as well, is really that level of portfolio management that's customized to a client's needs. I always say that every client is unique. They have unique needs. Some people's goal and need is to beat the market. If that is your goal, we will try to build a portfolio that meets that goal, but that's not normally everybody's goal. Their goal is either income or stability of income. Everybody's goal is unique, and what we try to do at Stonebridge is partner with advisors, take some of their high net worth clients and really build portfolios that are customized to exactly what they need. And that's our goal at Stonebridge.
And 100% the independence and that kind of alignment is definitely what we like for our clients. So let's jump right in. Let's talk about today's hottest subject, and that is AI investing. And that has really propelled the markets the last 3 years. Talk about that and talk about how you're positioning portfolios with that, John.
Yeah, so AI, I always say I managed money in 99 and 2000, and AI reminds me a little bit like it did back then, but then it was called the internet, and it was just all about connectivity, and the internet was going to make our lives better and more convenient and bring data to you quicker. AI reminds me a little bit about that, but it is different. And I would say there is a lot of hype surrounding AI. I think it's here to stay, and we are focused on it. And what we try to do is identify who's making the most money in AI and who's going to make the most money in AI long term. I think the jury's out on who's going to make the most money long term. It is clear today that companies selling the hardware into AI is what's driving the best performance, i.e., example is NVIDIA. It's now 8% of the S&P 500. Everybody has to pay attention to it. And they do have the hottest product in the early stages of AI, much like Cisco had the big advantage back in 99 and 2000 and was the best performing stock in that era. But timing is important and valuation is important when you look at AI. I'd like to think about if you bought Cisco in March of 2000, you broke even just this past year. So it took 26 years from that valuation peak to earn its way back. So stocks have a tendency to get ahead of themselves. But when we look at AI, it is affecting more than just chip manufacturers and storage manufacturers. It's really driving a lot of demand in multiple areas: construction to build the data centers, energy. There's a lot of need and the demand for energy is up dramatically as the data centers, use as much power as a small city does. So there's a lot of aspects of AI that are moving, and they're moving very rapidly. I mean, the demand right now in AI is insatiable, and people are throwing billions and billions of dollars to build data centers, and they want to be the leader, and they want to have the best AI, whether it's ChatGPT or Claude or Gronk or, we're still in those early stages. And to me, it's a great productivity enhancer. I think it's truly yet to be seen how AI adds revenues to a lot of companies in the long term, just like it took the internet a long time to figure out how you are going to actually make money on the internet. It ended up being mostly advertising, but
I'm glad you brought that point up, because we talk about this locally with our team. AI plus HI, which is human intelligence, equals ROI, return on an investment, and that's such a big thing. Talk a little bit about the energy aspect to AI, because that's a really hot subject throughout the whole country now. Is AI going to steal our low-cost energy? Talk about that a little bit.
Yeah, it's already stealing our low-cost energy, right? It's been interesting in the U.S. We've had it's been regulation that has really killed a lot of the utilities over time, right? Most utilities are regulated utilities. They can only raise prices so much a year, and they take what they can get and they add capacity as they can, but it's always very small. So in America, what we've had to do over the last 20 years is really figure out how to be more efficient, because our creation of energy hasn't gone up very much. LED lights. We've learned how to create much more efficient ways to use electricity and energy, and we haven't done much in creating new capacity in the energy production. So as these data centers are being built, we really I think we're within 12 to 18 months of a real issue where, okay, how can we keep growing artificial intelligence at this rate and not kill the consumer who needs to run their power in their home and everyday living, because that's going to have an impact. The answer to that is to build more energy capacity and build it in the right places too, because you build a great nuclear facility in Arizona or wherever, how do you get the power to where the data centers are? And our energy infrastructure isn't even as robust as it needs to be. I think there's solutions and people will figure out how to get there, but we clearly need more capacity in the energy market. It's just that regulations, the current administration is trying to break down some of those barriers and get it approved quicker. But even when you break down the barriers to get it approved, it's still going to take 2, 3, 5 years to build these new plants. So I think there's going to be a real crossroads that we're going to come to over the next, probably within the next 2 years of, okay, AI is great, but how do we control that demand and that growth, because we can't have the power to produce all the things we need to produce.
Absolutely. As the great Milton Friedman said, which I watch him on my treadmill every morning, or some mornings, regulation is what causes higher taxes too. And that's a hot subject from the voters, right? Is that I don't want to pay higher taxes, and I want lower cost to my products, but regulation's always adding that. Let's shift gears to the other big subject out there with our clientele and really in the country right now, and that's interest rates. We've really slowly behind the scenes watched that 10-year Treasury bump up to 440, I think probably even 445 in recent days. Talk a little bit about interest rates, number one, where you see them going, but number two, how you're positioned, because you guys are really unique in your positioning right now.
Yeah, so for a long period of time, the bonds we were purchasing for our clients, we kept them very short maturities. I think the furthest we were going out for a few years was about 3 years, because rates were historically low and you weren't getting paid very much to invest in fixed income. And that was the right call, but investors wanted more, right? So there's only a couple ways to get more out of a fixed income portfolio, and that's either to go further out on the curve and buy longer duration bonds with longer maturities, or you go down in quality. Right now, you're still not getting paid to go down in quality, right? That we haven't had a credit cycle in the United States for quite some time. So you're not really getting paid that much to take on the additional risk, and you were not getting paid to go further out. We made a decision about a year and a half ago that as rates rose to what I think is a much more reasonable rate and a decent real rate of return after inflation, because for years we had a negative real interest rate, right? Inflation was higher than the current interest rates on the 10-year. So right now, I would say we are to a level where real interest rates are back to their historic average and even slightly above that. So what we're trying to do with our portfolios is we've made the decision to lock in those what we think are very reasonable real rates of return for a longer period of time. So at Stonebridge, we have taken the bonds we are purchasing from that 3 years and under to about 7 years.
Okay, so I'm going to ask a really simple question here, and I haven't asked you this yet. Aren't you concerned with the levels of government spending to what that could do with the longer term interest rates? I mean, is there a theory out there that possibly sees that 10-year crashing through 5%, maybe going as high as 5.5%? Because we're $2 trillion under in spending, plus we got unfunded pensions in a lot of states. I mean, does that worry you at all?
Yeah, I think you could talk about that worry about government spending and our debt levels for probably the last 20 years.
Okay, that's true.
And yeah. I think that's always been a concern that investors have had. The government overall is responsible to pay their debts. And I think that there are multiple ways they can do that. We've seen how a lot of countries do it. They just print more money.
That's
but
true.
All that does is cause inflation, which devalues your currency and makes your dollar not worth as much. But we don't worry about government debt and the failing of government debt. I think that's always been a hot topic in the United States because we've done nothing but rise and rise and rise our debt levels. So we don't spend a lot of time worrying about that. I will say that there's a lot of corporate debt that's in a lot better position than our government debt.
I would agree with
that.
Yeah.
At Stonebridge, we focus less on treasuries and more on corporate bonds. Now, corporate bonds are related. The interest rates are always going to be related to the treasury market. But I think there's a lot of great corporate debt out there that's supported by the earnings of those corporations that are much higher quality than even government debt would be right now. But we don't really worry about the U.S. Treasury market defaulting or anything like that.
And we talked about this too. History rhymes, it doesn't repeat, right? And the great Milton Friedman also said that until the American voter stops voting for lower taxes and all these things, that we won't probably see that. So so the last thing I want to close on, I always close on this. I didn't tell you I was going to do this either.
Okay.
What podcasts do you listen to, or what books are you reading right now?
So when I travel, I read a lot of fiction because I spend most of my days just reading everything and research. But I would say there's a couple great books on AI. Warren Buffett's books, I've read them all. As the Oracle of Omaha, his books are incredible about really digging into why you buy companies. He's in his first case right now, right? He's retiring, and he just had his annual meeting in Omaha as well. But he's sitting on a ton of cash. He is buying treasuries like nobody's business, right? And I think what he's waiting for is valuations right now in the overall market and AI are extremely elevated. I worry about the concentration in the indexes. 44% of the S&P 500 is in 10 names, and they're all kind of AI related. That's a historic high. And I think what he is waiting for is a market correction.
Well, John, that's great that you still keep your Nebraska ties with Warren Buffett. I know you're still a Husker fan, which is awesome, and you still follow us, even though you live in this great state of Minnesota. Thank you for being a guest today. Thank you for coming out and seeing our clients this week. And thank you all for tuning in this week.
My pleasure.
Discussions in this show should not be construed as specific recommendations or investment advice. Always consult with your investment professional before making important investment decisions. Securities offered through Cambridge Investment Research, Inc., a registered broker-dealer, member FINRA SIPC. Fixed insurance is offered through various independent insurance companies. Cambridge does not offer tax or legal advice.